What's up, team? This is Ro, your best friend at JMSB. So here I was asked a question for COMM 217, Introduction to Financial Accounting. Let's have a look. Sutton Incorporated, a small service company, keeps its records without the help of an accountant. After much effort, an outside accountant prepared the following unadjusted trial balance as at the end of the company's fiscal year, December 31st, 2017. So we're offered a chart of accounts along with the various debit or credit balances for each account. Data not yet recorded at December 31st, 2017 were as follows. We're offered items A through E. In required 1, it says to prepare the adjusting entries at December 31st, 2017. So the truth is, I really like this question. Adjusting entries is definitely a concept that's going to appear on your midterm. And if you're looking for that A+ in this course, I would definitely practice as many of these as it takes for me to get the hang of the concept. So keeping that in mind, let's have a look at item A. So here it says, supplies inventory on December 31st, 2017, reflecting 680 remaining on hand. In item A, the idea is to understand that some of our service supplies inventory, which is an asset, is being used up. And whenever an asset loses value, the idea is to expense it. So at the beginning, we had 1,700 worth of supplies. The ending balance shows 680. So we should be able to argue 1,700 minus 680, 1020, is the amount that is being expensed. So in item A, we're simply going to debit supplies expense. And that's because expenses are equity accounts. And when they happen, they lower the value of equity. The amount is going to be 1020. We're going to want to credit service supplies inventory. And that's because service supplies inventory is an asset, and assets lose value or decrease in value by a credit entry. So let's have a look at B. Here it says insurance expired during 2017, 5/30. Here we need to understand that some of our prepaid insurance is losing value. And so again, we should expense it. The account is going to be called insurance expense. We're debiting this account because expenses lower the value of equity. The amount is 530. We're going to credit prepaid insurance, which is an asset. The reason we're crediting this guy is because assets lose value on the credit side. So we have less of the prepaid insurance asset. In item C, it says depreciation expense for 2017 is 3,800. And so again, we're going to debit depreciation expense. Notice how expense accounts always get debited. The amount is 3,800. And the account that goes hand in hand with depreciation is accumulated depreciation. This guy is a contra asset account. And this is the accumulated depreciation for service trucks, as we can see on the chart of accounts. So I'm going to call it the same. The amount is going to be 3,800. In item D, it says wages earned by employees and not yet paid on December 31st amount to 1,500. So here we want to make an adjustment for an accrued expense. It's an expense that has happened but not yet been paid. We're going to debit wages expense, equity going down. The amount is going to be 1,500. And since we didn't pay these wages, liabilities increase in value by a credit. And so we're going to credit wages payable. In item E, it says income tax expense is 3,350. So here you want to recognize that income tax expense has been incurred but not yet been paid. So again, it's an accrued expense. We're going to debit income tax expense for 3,350. And since we haven't yet paid it, we can argue that again we're more liable. The name of the liability is simply going to be income tax payable. Understand that liabilities increase in value by a credit, and therefore we are crediting this account. So there we have it. Those are the 5 adjustments that I would make for this example. I hope that this explanation helps, and if it does, please make sure to tag your friends that are taking the class. This way they would know how to do some adjustments as well. In the meantime, I hope you guys keep well, you study well. Ro out.